Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the Russell 2000 ETF, ticker symbol IWM. You can see here that I left my lines on the chart from last week, where last Friday I extended the upward leg here from the previous week and then added this downturn where I said the end of the line would represent the initial target, and then the second point here of 244.61 would be my secondary target. So you could see that yesterday on the 27th of May, we hit that, and now we have a red candle right there. You can see as I zoom in. That's a red candle. It's not a bearish engulfing pattern. However, we have a higher low, higher high on lower volume. The lower volume suggests that the buyers are running out of steam. Therefore, for next week, I'm going to erase these. For next week, I do believe we're going to pull back to fill this gap. 80% of the time, gaps fill. And so that's why I'm going with the downward move. We have a shortened trading week next week, Memorial Day. We are closed. So in that 4-day period that remains for next week, I think we're going to go down and hit that gap. So that's for IWM. If you look at the SPY, and then I'll go to the VIX after this, you can see that my lines were drawn again. Have to zoom in a little bit more so you can see this. Okay, Friday was right here, Monday, Tuesday, Wednesday, Thursday, and today as I record this, I said we would move up Monday and Tuesday and then start to pivot lower. We did move up. You see that big red candle. We did start to pivot on Wednesday, and we didn't hit this all the way down here to fill the gap target, but we do have red candles here. And now this red candle is starting to show increase in volume. So that's telling us that the sellers are starting to get motivated. So let me redraw these. I'm going to erase what we had. Reestablish my target price down here. I'm going to leave that in for as long as it takes, but I think that gap will fill. Initially, because we only have 4 days, like I said, I think we're going to pull back to that moving average with the end line target for SPY at 416.44. Now that brings me to the VIX. For the most part, the VIX is inversely related to the S&P, but the VIX didn't even take a break. It came down to my support level like I said it would, formed a hammer, or very close to a hammer pattern, which is that long shadow right there. Did not bounce, kept going down, but guess what? It's now at a new support level down here. Today, we close with a very slight hammer. Again, that's a second most bullish candle that you'll find. That support level down here, again, very close to where we had our low on the VIX today. That's a hammer pattern. Look at the CCI. Oversold now. But more importantly, look at the divergence between the K and the D. I talk about that quite a bit. This divergence is wider than the divergence we had back here. And look what happened during this 4-day period to the VIX. So I'm going to forecast higher, and I'm going to continue to remain at the higher levels up here around 23 because we have a wide divergence from that moving average. The market, in my opinion, is overbought, and the oscillators are starting to show oversold conditions, again with that wide divergence right there. So the VIX target, for those of you that need that number, 2236. It's not going to happen next week in one 4-day period, but I do believe it's eventually going to go back up. So that's the VIX. We take a look at the diamonds. This is DIA. Same thing that I did with the S&P. I said Monday, Tuesday would most likely go up. We're kind of hovering at my initial pivot target point right there at 347.21. Today, the high was 346.48, so we're even shy of that pivot point. But there is also a gap up here. So what I'm going to do is I'm going to draw that gap as a resistance line, keeping that in mind because once gaps fill, there's an 80% chance that prices will reverse from there. So I'm keeping this exactly the way it is, with the one exception is I've added my gap fill resistance point on the diamonds. Now let's take a look at the Qs because I want to look at this on the daily chart as well as the monthly chart. I want everyone to pay very close attention to what I'm saying here. Last week, I officially called the top. Now, I could tell already there's some people that may have misunderstood what a top means. It doesn't mean I've called a high. I've called the top. Well, what is a top? Well, if you look at the Qs, This is beginning to look like a classic head and shoulders pattern with the left shoulder right here. We have a head, it's almost like a double top formation here. And then if the market pulls back like I think it will, we will now begin to form the right shoulder. Now, when you're looking at a head and shoulders top or a complex head and shoulders, you'll see the neckline is usually drawn by connecting the lows on the troughs here. So if you can see my blue line that I just drew with this drawing device and how that correlates to the gap fill point, this area here is going to be a critical support level. Hence the reason why for our members, I am suggesting that to get out of any long positions or spreads when the IWM drops below 210, you could even say the same for the Qs, with the exception is that if we break out below this low here, for me, that would be all bets off for any new long positions. So for the Qs, I'm leaving this again exactly the way I drew it last week. I think there's a good chance we're going to come down and fill that gap. Again, 80% of the time that happens. And finally, if you look at the very top, that's a doji, almost a shooting star, very, very close. And that is another bearish candle. As the oscillators begin to roll over, we have this gap or divergence from the K and the D line on the stochastics, and the CCI is about to cross with a sell signal. Now, like I said, pay very close attention to the monthly charts, especially on the Qs. Look what's happening. This is a hanging man pattern right there. Today was the last trading day for May, and it ended with the second most bearish candle alongside the shooting star, which is right here. So we have a shooting star very close to the top. Now we have a hanging man. And notice that this red candle is now showing an increase in the red volume. Volume analysis tells us that when you have increase on the way down, the sellers are becoming more motivated. Now on the CCI, on the monthly, again, this is a monthly chart, we do have an official cross below the 100 line, which makes a sell signal there. And we have the stochastics is already crossed with a sell signal. So with this wide divergence on the Qs, what I would suggest is that if you have any tech stocks, I would, again, put some type of risk management plan together, whether it be sell stops, you can collar positions, learn about that. We teach that here at Market Rebellion. What a collar is, you sell calls, generate money to buy insurance in the form of puts. You could use option spreads. There's lots you can do to participate in a down market. And I'm giving everyone a lot of time to prepare. I don't think the collapse is going to come right away, but I do believe that the markets are in jeopardy of much lower prices down the road, especially as our economy starts to weaken with all the spending. Again, there's counter opinions on that where money's being pumped into the system. They say you don't fight the Fed, but there's a point in time where you have to draw the line and say, okay, how much is too much spending? And guess what? Who's going to pay for all this? Well, it's me, you, and all the rest of the taxpayers are going to pay for it. And if they start holding on to their dollars because they have less to spend, that's what drives us into recession and also into economic downturns. So again, just a view to look at the charts, keep your risk management plan in place. Go back and review last week's report so you can understand what I talked about with regard to the prelude to the crash of 29 and the crash of 30. So you can see that it's very obvious to me that history is repeating itself, and you certainly don't want to ignore that, because if you don't learn from your past, you're just going to repeat it. So have a great long weekend, and we'll talk to you next week. So long.